you so much for having me. This is my first CLA roundtable session, so I'm delighted to just kind of be observing the first half of the agenda and the things that you go through. My name is Alex Corvin. I'm the Chief Product Officer at Ourboro. We are Canada's first and largest privately funded provider of shared equity investments. I'll get into just what that is. So today I'm here to give you an overview around just what is shared equity and what does it mean for lenders that are delivering mortgages that may have a shared equity investment component to it. So I will now share my screen, Dean, as per your instructions. All right, welcome, thank you. So today I'm going to be covering a high level, what has been driving force behind the need for tackling some of the affordability issues in terms of housing. At Ourboro, we have been getting increasing interest from lenders who want to add shared equity investment options into their mortgage portfolios. And also, as a background, OSFI came out in May of 2022 with clarity on guidelines on where and how these shared equity programs can be allowed. So it's certainly, since then, it's certainly made it much more clear and simpler for lenders to evaluate whether or not this is something they want to add to their portfolios. So I'll speak about kind of the impetus for shared equity, and then just like how is shared equity defined, specifically what is and isn't allowed under current regulatory guidelines, how it works kind of in practice. I have an example of even just like a mini case study of what it works for our home buyers. And then the third point here, having worked with numerous lenders, myself specifically across various other teams, like whether it's legal teams or credit adjudication teams or risk teams, I can give you a bit of an overview, like for those of you who are considering shared equity, just what it's like to bring in shared equity into your portfolio, specifically, intake, servicing, and the sales side of mortgage administration. And then time permitting, I can show you just some of the research behind the social impact of removing barriers towards home ownership, especially for those who may be interested in how shared equity may fit within your ESG principles within your organization. So, and then obviously lots of time for Q&A at the end. So we'll jump in right there. The need for innovation, first and foremost, I'll just start that shared equity investment is a direct response to a market gap that has truly emerged because of this divergence between home prices and income. As you can see through this graph here, we know that residential real estate has been one of the most stable forms of generational wealth creation. But as a result of this growing gap, fewer and fewer people are able to access this investment vehicle, not only as like a form of housing stability, but also as a tremendous tool for wealth accumulation. So as it happens now, like only those who have access to generational wealth are able to kind of break into the housing market. If your parents are homeowners, you are twice as likely to have a home compared to those who don't have a generational stake in the housing market. And that's actually just a recent StatsCan report just from November of last year. And consequently, close to a third of Canadians who are buying homes are getting money from the bank of mom and dad. So what happens if you don't have money from the bank of mom and dad? Well, a recent National Bank survey suggests that it would take a household making over $250,000 a year, close to 26 years, to save enough to purchase a non-condo in Toronto. It doesn't get too much better outside of Toronto, to be honest. Like Hamilton's almost just as bad. And there are government initiatives to help. Obviously, like on the supply side, there's the More Homes Built Faster Act, like the Ontario Housing Supply Action Plan. And then on the demand side, like many of you may be very familiar, CMHC has a first-time home buyers incentive, which is, they call it a shared equity mortgage. Very similar. I'll get into some of the nuances, the differences there, but those programs alone aren't enough to obviously kind of break that down payment barrier. So what is shared equity? By definition, it's a contribution towards a down payment in exchange for a share of the future appreciation on the home. It allows families to break into the housing market and kind of get that down payment that they need without taking on more debt. And this is important. This is quite novel in the Canadian landscape. Traditionally, you either rent or you buy a home with a mortgage. And this is not, I wouldn't even say it's in the middle of renting versus owning because there's no rental component. This is just a new way to kind of share ownership in a home with a third-party investor. So I'm going to go through now some of the key features of shared equity and kind of under the umbrella of what OSFI currently allows in Canada for shared equity. I will say for those who are interested, there is an OSFI bulletin. This is the one I'm talking about that came out in 2022. It's titled Clarification on the Treatment of Innovative Real Estate Secured Lending Products under B20. So we can, I can send a link to this later as well too. So if you want to read through the bulletin yourself, but essentially things to look out for. A shared equity investment has to be on terms that are pari passu with the home buyer. What does that mean? Like an equal sharing of risk and reward on the investment terms. But most importantly, it means that the equity investment cannot resemble a loan. It cannot look, smell, like in any way, look like a debt product. That's what the bulletin is most emphatic about. So there can't be any fees to work with shared equity investment provider. Our interpretation and obviously our lending partners, there can't be any sense of a guarantee of a return of principal, so that whatever the shared equity investment provider is contributing towards a down payment, that's risk capital. There shouldn't be any guaranteed repayment and obviously no interest. On the guarantee of principal part, what does it look like? It could be a mandatory repayment or even a loss floor in a certain way. And then it could also be, most notably, we see a collateral charge that's registered against the property. So kind of giving that shared equity investment provider priority repayment on the loan. Obviously still second to the first mortgage, but just the presence of a collateral charge is kind of one of those flags for it being a loan product. I have asterisks beside these, and that is because there are exceptions under B20 for nonprofit programs, and specifically the Canadian government CMHC First Home Homebuyer Program does not meet some of these criteria. Like it functions a bit more like a loan. And I'll get into that in just a second. And obviously, last but not least, the mortgage has to be in first position, obviously, and then gets received priority repayments in the instance of a sale. So in essence, a shared equity investment is an investment provider, and the investment itself is a third-party contribution. They are not party to the mortgage application. So a shared equity investment provider's relationship with the borrower is strictly outside of the mortgage terms. They are in second priority to the mortgage, and there's usually a standalone agreement that's executed between the shared equity investment provider and the home buyer. Now, I talked about the CMHC program. So one of the things I did is actually created a table to show some of the key differences between other like emerging trends or innovations and helping individuals break into home ownership. I won't go through all of them here. Obviously, shared equity is here on the left. The CMHC program hits a lot of these, except for those who may be familiar, the CMHC program has a loss floor in the sense that the government is guaranteed a repayment of a portion of the principal they provide, but at the same time, they also have a cap, like an earnings cap, and then they do use a collateral charge as a way to register the mortgage. So, shared equity, as we talk about today, kind of excludes the CMHC program. The only one I'll highlight here is we get compared often to the cost and benefits of owning with friends and family, which is, growing in popularity as people look for creative ways to break into the market. The biggest difference is that homeowners do not share their property. They're not sharing their space with anybody else. And obviously, as mentioned, the shared equity investment provider is not entitled to the mortgage. So in the shared equity investment case, the homeowner has 100% use and benefits of the property. They're on the mortgage, so they're responsible for the mortgage carrying costs, property taxes, and obviously maintenance and upkeep of the property, which, is commensurate with them being able to enjoy 100% of the property. Now, moving on, just kind of summarizing some of the key benefits, of which I may touch on already. Mostly when we talk about shared equity and we're working with buyers in the market, a little bit too fast. Some of the big, like the main feedback we get is obviously reducing the time it takes for people to save. I mentioned 26 years of savings to break into the market. Our research, we help buyers reduce that to just 9 years. So they're saving the amount of savings they need. It's 9 years worth of savings, about 10%. So that's significant acceleration in the path to home ownership. And that just unlocks like invaluable economic and social benefits, obviously, for the homeowners. I have an example of a case study on just how shared equity works in a purchase of a home. But I will also touch on number 4 here in terms of the impact on lenders. We've had the benefit of having phenomenal lending partners. I think Ashley Yancey is here today as well too, from Equitable Bank. But one of the key value propositions we know for lenders is that it really does open up your borrower pool. Those who otherwise would have written themselves from ever even hoping that they would be able to afford a home now have an option to do so with a shared equity investment provider. So those, you have clients in your financial institution, anybody who has a TFSA, a first time home buyers TFSA, or RRSPs that they can draw on, all of a sudden that's a new audience of people that you could introduce home ownership to. And obviously there's tremendous opportunity to kind of be that early mover advantage as well too. And there's, depending on the shared equity investment program, there's definitely opportunities for the mortgage to be de-risked because of the role that a shared equity investment provider may be able to help in, whether it's remedying defaults or even just like supporting that homeowner along their ownership journey. All right, so now I'm going to get into, shared equity in action. I have a case study. This is a very, very common example. Obviously, we change the names and specific scenarios, but we see a very distinct difference in value proposition for shared equity between those that are looking to purchase a home under $1 million and those who are purchasing over $1 million. So for this example, it's a couple, Amara and Sam, who are purchasing an $800,000 home. So this is really what it comes down to. They have $80,000 in savings of what they thought would have been enough for a down payment. And they're looking to buy $800,000 property. Even with $80,000 down payment, or what they would think like 10% the value of the home saved, they still need to qualify for $745,000 of mortgage, and that includes the CMHC mortgage insurance. So overall, right out of the gate, they're at 93% LTV, but they do have 100% equity in the home. Now, as mortgage rates have increased, we have seen an erosion of affordability for a lot of buyers. A lot of folks who thought they had the minimum down payment needed, all of a sudden can't buy the home that they thought they could afford because they just don't qualify for enough mortgage. So in this instance, whether Amar and Sam decided that they want to take on less debt or they just didn't qualify for enough mortgage, using shared equity, the shared equity investment provider helps get them to a 20% down payment. So with their 80,000 and the shared equity provider's 80,000, the remaining mortgage needed is only 640. So that's 80% LTV, and Amar and Sam has a 50% equity. So if you kind of really, to be really reductive about it, for the sub 1 million category, homeowners are giving up equity, but they're reducing their debt. And in this case, they have $100,000 less mortgage, which with interest rates today roughly translates to savings about $700 per month. And so this is below $1 million, where obviously if people don't have the 20%, they may still be able to buy on their own. Like this could be a choice that they make. Or if obviously if they don't qualify for enough, that's not a choice. For above $1 million, it's actually really interesting because obviously above $1 million, you need 20% down payment, and people do not have $200,000 to $250,000 of cash. That's where the bank of mom and dad comes in, obviously. But that's where using shared equity for a purchase over $1 million is the difference between renting forever versus being able to own and have a significant ownership stake in a property today. So I, use that example for those who are from the mortgage brokerage community as, in terms of wrapping the picture of the value proposition of shared equity. So now I'll get into what it means to add shared equity into your mortgage portfolio. There's, I have a lot of bullet points here, and Dean, I don't know if these slides will be circulated after. I know that this will be recorded, so there certainly will be an opportunity to review the things in detail. I'll just touch on some of the key points here, and I'll emphasize that this is from our learnings. Like shared equity, admittedly still relatively new and novel in Canada. We are, as I mentioned, at any given time, we've been working with many lenders, whether it's A lenders, alt lenders, who are at various stages of onboarding shared equity into their program. So this is from our experience of what they go through, the questions they ask, and obviously every financial institution is different in terms of how they adjudicate risk, how they evaluate regulatory or interpret regulatory guidelines, et cetera. So this is from our perspective. First and foremost, in the underwriting and intake process, the main thing is that on the credit adjudication side, there's no impact. Obviously, a source of individuals' down payment funds or even the amount of down payment somebody has doesn't impact their GDS, TDS ratios. So, when you receive a mortgage application that has somebody where somebody's using a shared equity investment, it doesn't change the underwriting practices. And from the OSFI guidelines, assuming the criteria is met, the shared equity investment, that down payment contribution amount that's coming from an investor, can be considered a borrower's own funds. Now, when you are evaluating source of down payment funds, like going through your, actually, it's interesting, Dean talked about the AML side, but when you're confirming the source of down payment funds, what that looks like in the instance where you have a shared equity provider is a investment confirmation, an agreement, or a letter from that shared equity investment provider confirming their contribution towards a down payment. At Ourboro's case, we will actually deposit or transfer our contribution amount into escrow with the legal teams, and who holds it in trust on behalf of the buyer. And even that trust statement could be used as confirmation of source of down payment. just as an example. The emphasizing again, because the shared equity investment provider is not on title, they're not on the mortgage application. So they're, for all intents and purposes, irrelevant when it comes to the mortgage application itself. So you're not going to see them in the paperwork or in the application documents. That said, the borrower will go through their own application process with the shared equity investment provider. That can be done before or after they get approved for a mortgage. Obviously, it's preferred that they kind of get qualified for a shared equity investment prior to applying for a mortgage. But as an example with Ourboro, we get people coming to us with signed APSs and, they're 3 weeks away from closing as an example. So we do accommodate that. And the last two things around the closing side, no change to the lender's process in terms of closing. You're still sending your instructions to the lawyers, your restrictions on title, your lien and collateral charge or standard charge is still registered in the exact same way. Depending on how the shared equity investment provider registers their restriction, they may use some specific legal tools. They should not be using a collateral charge, as mentioned earlier, but there may be restrictions that prohibit, an illegal sale, like the property being sold without their consent. Any of those restrictions will be registered after, like in second priority to the first mortgage. In terms of servicing, no restrictions on your ability to administer the mortgage, manage payments, renewals, etc. Depending on how the shared equity investment provider protects their interests, there may be some restrictions around the borrower taking on additional financing, like creating additional leverage on the property or transferring their mortgage to a new financial institution. But other than that, when you need to discharge a mortgage, there's no impact, no restrictions. And then I'll touch on a little bit on the buyout scenario. So this may differ from a provider to not, some are 25 years, some are 30, but at Ourboro, we allow co-owners to co-own with us for up to 30 years. And at any time during that 30 years, they could offer to buy out Ourboro's share. And when they're doing that, usually that's coming from a combination of their own savings or them refinancing their property. So when it's time for them to refinance, or like when their mortgage is due for renewal, they may refinance and use some of those proceeds to buy out Ourboro's share. And that will obviously trigger, the consent that may be required as part of the additional financing. But other than that, there's no impact. Like you would be approving secondary financing on the property in the same way as if somebody didn't have a shared equity investment. We see this happen with buyers who may have a divorce settlement or have an inheritance, and they use that to buy out Ourboro's share during the co-ownership period. Okay, last but not least, in terms for lenders, is the sale scenario. This sale scenario is actually quite simple. In a vanilla sale, the borrower has the full right to sell at any time. And that's really important when we talk about, if you recall in the beginning, pari passu rights between the investment provider and the buyer. The borrower needs to have absolute freedom to leave the property and sell. Even if markets are down, the shared equity investment provider cannot be seen as interfering in their ability to sell the property. So they can sell the property at any time. And then one thing to keep an eye out for, like at Ourboro example, we have the ability to help, or we incorporate into our agreement the ability for Ourboro to help remedy any defaults. So say at time of sale, there are defaults outstanding that may prevent a sale. The shared equity investment provider may be able to help in those instances and to remedying those defaults, because obviously it's in their best interest to be able to have a smooth sale process. Otherwise, mortgage is in first lien position. The mortgage provider gets paid out first, and only if there are any proceeds remaining are those distributed between the home buyer or the homeowner in this case and the shared equity investment provider. And that will be done in accordance to the terms of the shared equity agreement that would have been executed between those two parties. And that's pretty much it. Like those are kind of the three key areas of consideration if you're thinking about adding shared equity to your portfolio. As I mentioned, it's definitely growing in interest. We're getting a lot more lenders asking about, how can I open up shared equity to my borrowers? Because it definitely reduces the amount of deals that get turned away, whether buyers just don't have enough down payment or they don't qualify for enough mortgage. I think I have, over time a little bit, but I'll show you the extra additional slides I have left is like at Ourboro, we come from, like, our company comes from deep impact roots. So when we look at addressing the housing affordability crisis, we look carefully at the social impact of our work. And obviously, there's a lot of quantitative data around the benefits of home ownership. But for us, it's not just about, okay, let's get more people into home ownership. That's good. We're looking at who's left behind. And we're seeing that there's a disproportionate amount of visible minorities that are just consistently being blocked out of home ownership. And so we're able to target some of these areas and help kind of rebalance the scales in a bit. I have some additional slides in the appendix as well, but in terms of SDGs or some of the impact metrics that your institution maybe you're looking closely at, there may be some resources here or narrative that may help as well too. I will put up these kind of key takeaways from the presentation today to maybe help juice up any Q&A or discussion questions that you guys may have. I feel like I've been talking a mile a minute to get through these points, but happy to open up the floor.
Thanks, Alex. That was amazing, and definitely super interesting. As Alex said, let's open up the floor. Any questions for Alex? Clarifications, ideas?